Hello, everyone, and welcome to my channel. If you're passionate about investing or just interested in building a successful portfolio, you're in the right place. Today, we're going to talk about a crucial topic, value investing. It's a strategy used by the greatest investors in history, and one of its main proponents is the legendary Warren Buffett. In this video, we'll see how you too can adopt this philosophy to identify undervalued stocks and take advantage of the opportunities the market offers you. So don't forget to subscribe to the channel and hit the bell to stay updated on all my investment-related content. Ready? Let's get started. What is value investing? Let's start with the basics. What is value investing? Value investing is an investment philosophy based on finding and purchasing stocks that the market is valuing below their real worth. This difference between price and value is what investors call margin of safety. The idea is quite simple. If you can buy an asset for less than its intrinsic value, you have a greater chance of achieving returns in the long term. Warren Buffett is undoubtedly the most famous proponent of value investing. He developed this strategy under the guidance of his mentor, Benjamin Graham, author of the renowned book, The Intelligent Investor, which defined the basic principles of this methodology. Graham believed that markets are often driven by emotions, which can lead to periods of inefficiency in stock prices, offering opportunities to patient investors. 1. The difference between price and value. One of the first things we need to clarify is the difference between price and value. The price is what you pay for a stock, while the value is what you receive. In the short term, the price of a security can fluctuate greatly due to factors such as market sentiment, news, or geopolitical events. However, in the long term, the price tends to align with intrinsic value. Warren Buffett takes a very disciplined approach to this difference. He does not get swayed by short-term market fluctuations. Instead, he focuses his attention on buying solid companies with clear and predictable business models, which he believes can thrive in the long term. The basic concept is that a smart investor buys when the market undervalues a company's real worth. This undervaluation can occur for various reasons: bad short-term news, widespread fear among investors, economic crises, or simply a misunderstanding by the market of the company's true fundamentals. 2. Calculating intrinsic value. But how can we know if a stock is really undervalued? Here is where the concept of intrinsic value comes into play, representing the actual worth of a company based on its financial fundamentals, such as revenues, profits, cash flows, and future prospects. One of the most used methods to calculate intrinsic value is the discounted cash flow, DCF. This technique involves estimating the future cash flows that a company will generate and discounting them to present value. The higher the expected cash flows, the greater the value of the company. A DCF calculation involves two main components: estimated future cash flows. This is about how much money the company will generate in the coming years. Discount rate. This represents the opportunity cost or the expected return of an investment with similar risk. Although the DCF is a valuable tool, it is not infallible. It requires making assumptions about future cash flows and the discount rate, which can vary significantly. However, if used correctly, it can provide a reasonable estimate of a company's intrinsic value. 3. Fundamental analysis, financial statements, and data. Another crucial step in evaluating a company is the analysis of its financial statements. Buffett pays close attention to this phase, as financial data provide a window into the operations and health of the company. Here are some key indicators to examine. Revenues. Revenues should be stable or growing over time. Steady revenue growth demonstrates that the company can attract customers and increase sales. Net profits and profit margins. Profit margins, especially the operating and net margins, show how well the company can convert sales into profits. A higher margin indicates better operational efficiency. Return on invested capital, ROIC. This indicator measures how efficiently the company uses capital to generate profits. Buffett looks for companies with high ROIC, which suggests optimal efficiency in capital use. Debt. Companies with high levels of debt can be vulnerable during economic downturns. Analyzing the debt-to-equity ratio helps understand if the company is financially sound. Buffett prefers to invest in companies with low levels of indebtedness because he believes excessive debt increases the risk for the investor. A thorough analysis of these elements can reveal much about a company's financial solidity and its ability to generate long-term value. 4. The moat. Sustainable competitive advantage. Another fundamental aspect of value investing, according to Warren Buffett, is the search for companies with a strong, sustainable, competitive advantage, or as he calls it, a moat. A moat protects the company from competition and allows it to maintain market share in the long term. Here are some examples of moats. Strong brand. Companies like Coca-Cola have such an entrenched brand in the market that it is difficult for competitors to displace them. Patents and intellectual property. Pharmaceutical companies, for example, often have a moat thanks to patents on their drugs. Economies of scale. Large companies like Amazon or Walmart benefit from economies of scale, which allow them to offer products at lower prices than competitors. Network effect. Companies like Facebook or Google benefit from a network effect, where the more users there are on the platform, the more useful and attractive it becomes for new users, creating a barrier that is difficult for new competitors to overcome. 5. Margin of safety. Once a valuable company is found, the next step is to determine the right purchase price. And here comes the concept of margin of safety. The margin of safety is the difference between the current market price of a stock and its estimated intrinsic value. Warren Buffett never buys stocks unless he believes there is a significant margin of safety, i.e., a protection against potential valuation errors or unforeseen adversities. For example, if you have estimated that a company's intrinsic value is $100 per share, you might decide to buy only when the price drops to 70 or 80 per share. This guarantees you a sufficient margin to absorb any errors in calculations or market fluctuations. 6. Patience and discipline. The key to success. Another essential element of value investing is patience. Warren Buffett is famous for his ability to wait years before finding the right opportunities. There is no rush in value investing. It involves waiting for the market to offer stocks at prices below their intrinsic value. This discipline is crucial. Many investors panic when markets crash or follow fads, investing in sectors that seem promising only to find out they were overvalued. Value investing teaches you to resist these temptations and focus on the real value of companies, rather than on market fluctuations or short-term trends. A concrete example of patience and discipline? Consider how Warren Buffett invested in Coca-Cola back in 1988, during a period when many investors were uncertain about the company's future. However, Buffett saw a company with a strong moat and long-term growth prospects. He maintained this position for decades, reaping huge profits thanks to his long-term vision and patience. 7. Practical examples of undervalued stocks. Buffett's strategies. Now let's take a look at some concrete examples of how Buffett has put the principles of value investing into practice. Apple. In 2016, Warren Buffett surprised many investors by purchasing a large stake in Apple shares. At that time, the share price was considered high by some analysts, but Buffett saw a company with an extremely strong moat, a powerful brand, and a loyal customer base. More importantly, he saw that the company was generating a huge amount of cash flow, a crucial element in his assessment of intrinsic value. Despite market doubts, Buffett continued to accumulate Apple shares. Today, that single investment represents one of the greatest successes in the history of value investing, with an increase in value that has significantly contributed to the growth of the portfolio of Berkshire Hathaway, his investment company. Bank of America. Another classic example is Buffett's investment in Bank of America during the financial crisis of 2008. Many investors were fleeing bank stocks for fear of failures and losses. However, Buffett saw a unique opportunity in Bank of America, thanks to its solid fundamentals and its moat in the U.S. banking sector. He bought at a very discounted price, and years later, the investment proved to be extremely profitable. These examples teach us two fundamental things. 1. Do not be discouraged by short-term pessimism. Buffett knows that economic crises and recessions are oftentimes when the best opportunities present themselves. 2. Look beyond market noise and focus on fundamentals. Even when the market seems to flee from a sector or a company, it is essential to remain disciplined and base decisions on data, not emotions. 8. How to identify undervalued stocks in your portfolio. Now that we've seen how value investing works and how Warren Buffett applies it, the question becomes, how can you identify undervalued stocks for your portfolio? Here are some key steps. 1. Start with what you know. One of Buffett's best-known tips is invest only in what you know. This means that, first of all, you need to focus on sectors and companies that you understand well. If you understand how a company earns and maintains its profits, you will be in a better position to assess its real value. 2. Study the fundamentals. After identifying a list of companies that interest you, start studying their financial statements, financial reports, and business models. Look for signs of stable growth, a strong moat, and the company's ability to generate cash flows in the long term. 3. Calculate intrinsic value. As mentioned earlier, calculating intrinsic value is essential to determine if a stock is undervalued. You can use methods like discounted cash flow, DCF, or look at the price-jock earnings, PE ratio, relative to the industry and the company's historical average. 4. Maintain a margin of safety. Never buy stocks just because they appear cheap compared to their historical highs. Always ensure there is an adequate margin of safety. This will protect you from potential fluctuations or valuation errors. 5. Be patient. Value investing is not a strategy for quick riches. You might have to wait years before the market recognizes the real value of a company. As Buffett's examples show, patience is often key to achieving exceptional returns. 6. Avoid following the crowd. Another of Buffett's tips is to avoid following the herd. When the market is euphoric and everyone is buying, prices are likely to be overvalued. Conversely, when the market is in crisis and everyone is selling, great buying opportunities might emerge. Discipline is essential. Buy when others are selling and sell when others are buying. 9. Practical tools for value investing. Now that you understand the fundamental principles of value investing, it's important to discuss some practical tools that you can use to enhance your analysis skills. 1. Stock screeners. There are many online tools that allow you to filter stocks based on specific criteria, such as the PE ratio, ROE, debt to equity, and more. Yahoo Finance, FinViz, and Morningstar are just a few examples of sites that offer free and easy-to-use screening tools. 2. Earnings reports and financial statements. Don't just rely on surface data. Read the earnings reports and financial statements of companies you're interested in. Analyze their ability to generate revenue, profits, and cash flows over the long term. 3. News monitoring. Although value investing tends to ignore short-term noise, staying informed about news that could affect a company's performance is still important. Changes in management, new regulations, or acquisitions can significantly impact a company's intrinsic value. 4. Financial analysis software. There are various software options dedicated to financial analysis, like Bloomberg Terminal or Refinitiv Icon, which provide detailed data on company fundamentals. More affordable tools like Simply Wall Street can also help you make estimates about a company's intrinsic value. 10. Common mistakes to avoid in value investing. Before concluding, I want to mention some common mistakes investors make when adopting value investing. 1. Focusing on price without considering value. Remember, the price of a stock says nothing about its real value. Just because a stock is cheap doesn't mean it's undervalued. You must always perform fundamental analysis before making an investment decision. 2. Lack of patience. Value investing takes time. Many investors sell too soon because they expect quick gains. The key is to remain patient and trust your long-term analysis. 3. Following fads. Investing in what is popular at any given time rarely leads to positive long-term results. Focus on the fundamentals and don't get distracted by current fads. Value investing is much more than just an investment strategy. It's a disciplined and patient approach to building wealth over the long term. By following the principles we've explored today, from analyzing fundamentals to calculating intrinsic value to maintaining a margin of safety, you can improve your investment decisions and make more informed, profitable choices. Warren Buffett has demonstrated throughout his long career that investing in value can yield extraordinary results, provided you have the patience and discipline to do it correctly. If you consistently apply these principles with care and attention, you might well be on your way to achieving similar outcomes. If this video was helpful, please leave a like and subscribe to the channel. Let me know in the comments what topics you would like to see covered in future videos. Thanks for watching and happy value investing to everyone. You investing to everyone. You investing